Tuesday, May 30th. It's incredible, Dan. We're on the precipice of the second half of 2023. This is Market Call. It's just Dan, Nathan. It's just Guy Adami. It's just 1 p.m. And we're going to 5,000 in a half hour because that's what we attempt to do. This Market Call, of course, brought to you by CME Group, Dan, where risk meets opportunity. And, of course, our data provider has been and will continue to be FactSet. How are you, Dan, Nathan?
I'm doing well. Financial data and analytics powered by tomorrow. And tomorrow will be the last month of this month of May where, some people, not you, some people as it relates to the stock market, they got some of those sayings. They say what? Sell in May and go away. I mean, that didn't really help this month of May, did it? I mean, we're like the S&P has been just in this really tight range. We've talked about it. The VIX, the index that tracks the volatility of that fine index or the 500 stocks. I mean, it's been like pinned. It's like a teenager. It's like a unruly teenager. It's one of those ones that, wants to be 17, but really can't get there, guy, right? And so we got 1 day left here, buddy. And we wake up here, we got this debt ceiling deal. I don't think you or I ever thought it was really going to get tripped. We did think there might be some political ramifications that would kind of take this thing to the 11th hour. I'd say it's kind of the 11th hour, but it seems like we have a deal.
Yeah, in principle, still needs to be voted upon. Now, Janet Yellen gave the drop, and I hate using the term, but the drop dead date went from June 1st, which was this week, to the 5th, which I don't think it's any irony or coincidence that the 5th gets us to Monday. So it gets us a weekend to sort of wrangle this thing out, which will be sorted out. And I think we've said it all along. I thought the market would react more disfavorably as we went further into this. But I think all along the market was saying, we know you're not going to trip this thing. So why should we even bother selling the market when we know it's going to be rectified? And I think that's what we're seeing here. In terms of what we're seeing in the broader market, 4,200 in the S&P, the NASDAQ continues to party, as you like to say. Russell continues to be under pressure. The VIX, oddly enough, actually spiking over the last hour or so, but still relatively tame, below 18. Regional banks under pressure. So I guess the point is there's something for everybody in this. There's something for the bears, and there's clearly a lot for the bulls.
Yeah, let's talk about the S&P. If we look at the day chart here, it wasn't like, and listen, I think, you and I were talking earlier, you made this point, I think fairly succinctly, that Friday's action was in anticipation, right? That we would have some sort of framework for a deal that could get voted on this week. So the market kind of rallied ahead of that. We had a close above 4,200 in the S&P 500. You look at the day chart here, we've been selling into it. And there's plenty of areas. You just mentioned the banks. I mean, when I look around my main FactSet screen, we're going to hit some of these things, but I see retailers acting horribly. You've been talking about the Target. It's down 3%. We know that some of these these kind of department store stocks, we're going to get a couple reports from them this week, Macy's and Nordstrom's. They just act horribly in front of their reports. Look at the main money center banks. Bank of America is down nearly 1%. Wells is down 1.5%. Goldman's down 1% in the investment banking space. Not particularly great. Crude oil and the major energy stocks. We're going to look at all those, but they don't act well, right? The resource stocks don't act well. There's, so I mean, to me, other than what's gone on in tech, it doesn't feel great. Look at the S&P chart, though. You mentioned that 4,200 level, guy, right? So we had the close above it on Friday, kind of, either side of it today, and so to me, that doesn't feel particularly great. But I think the most important part of the S&P 500, when we think about it, is that, okay, there it is. I mean, very constructive chart. You look at that 200-day, it's down there at that uptrend that's been in place from the October lows. It really feels like, what is the gusto that's going to get it going above 4,200 meaningfully? Is it going to be a positive vote on the deal? I don't think so.
No.
We have 43.35 in the August highs in the futures here, guy. But I guess more importantly, let's pull up the equal weight S&P. And I want to see what your eye sees when you look at that versus, and maybe they'll toggle, that Jacob can toggle back and forth. That's not constructive. You know what I mean? So talk to me about the relationship between the market cap weighted that's being drawn up by 5 or 6 stocks and the equal weight, which really feels like it's stuck in the mud.
Let's go to the equal weight because I think that tells the better story. The equal weight suggests we continue to fail at the moving average. The equal weight suggests that but for a handful of stocks, the market's been sort of nowhere stuck in the mud. and we're nowhere near where we were, obviously, earlier this year and late last year. So I think it's telling a great story. If you go back and toggle back real quick, today's actually an interesting day, believe it or not. I know not a lot seems to be going on, but we actually traded up to 42.31 in the S&P. We've obviously given all of it back. It's going to be interesting to see how we close today, because if we do in fact close lower, people will start talking about outside days and our failure to sort of get to the prior highs back in August of last year. When I think it, Dan, you probably know 43 and a quarter or so, I think was the high that day. So,
Yep.
and if you go back and look, we touched the 200-day moving average that day and then subsequently failed. So if this is the day where, for whatever reason, things seem to be reversing, which they are, other than a handful of stocks, we're going to have a story on the back end. But in terms of the debt ceiling, I don't think at this point the debt ceiling is market moving either way.
Yeah. Well, let's look at the NASDAQ futures here, the E-minis. And I think this is interesting because, again, we look at that breakout back in mid-May, May 15th or so, above 13,500. We went straight to 14.5. And when you think of that, so you could look at the NASDAQ 100 guy and you could say, okay, well, Microsoft, Apple, Amazon, Google. Google was a huge participant. They had their Google I/O earlier in the month and got going here, but this is all related to the same trade. And then what happened with NVIDIA starting Thursday's gap and the follow through here, that's that 1,000 points in the NASDAQ 100. Okay. And that seems pretty concentrated in those names. But then there's other things that are going on here. Lots of other software stocks have been sucked up. Adobe got going. Look at this C3 AI. It's doubled, guy, in a month. Look at the move that Palantir has had. It's up 7% today. So the breadth among this story is broadening out, but it's not broadening out in a way that I think is particularly constructive if you think that the NASDAQ futures or the 100 futures can hold these gains. Because if everyone heads for the doors in those 5 stocks at the same time, it's going to get really ugly. I really think, though, Guy, we're going to have a down 3, 4, 5% day in one day in the NASDAQ 100 in the not so distant future.
So let's take a look. If folks can sort of move their eyes to the left of the screen and go back to August of last year, when the NASDAQ had one of these runs to the upside, and you can see we got close to, but we failed effectively to get to the 200-day moving average. And then you see the subsequent sell-off. Okay, just sort of keep that in mind, because look what we've done here. If you go back and look, we got down to and then bounced off the 200-day moving average in March. But each time when you start getting 2 or 3 standard deviations away from the moving average, which is what happened, by the way, if you go back and look sort of October, November of 2022, and that's where we are now, these things become mean reverting. So to your point, that day is, I don't want to say imminent because I sound like I'm being dogmatic, but that day is in the cards, and I don't know what it's going to be on the back of. It's hard to say. It's interesting. You had that NVIDIA filing on Friday. Their shelf, $10 billion is not a big deal. But by the way, good for them. This is a great opportunity to raise money if, in fact, that's what they decide to do. The market, again, doesn't seem to care. And when you have people tripping over themselves, I mean, if we can pull this chart up real quick, AVGO, which reports, I believe, on Thursday, Broadcom or Avago, whatever they call it now. I don't know if Jacob can do that or not. You had a 10% move in this stock in a day last week. And I bring that up because this isn't a $30 billion stock. This is a $300 billion company. And it's just not natural, Dan, to have moves of that magnitude. So when you start seeing weird things like that, look, I mean, just look at that chart. I'm not trying to be hyperbolic here, but look at that.
Pull up the one day. I mean, if this thing is almost $100 off of its highs, that's sort of buying, okay? And you've used this expression in the past. That is panic buying. That is either short saying, get me out, or it's longs who are just underexposed to this whole trade, and they think from a valuation differential, this is a great way to do it. Marvel has had similar price action. So if Broadcom goes down on the day, 2 days before its earnings, I mean, if NVIDIA goes down on the day, you're going to have a NASDAQ that closes down 2 or 3%, in my opinion, because if that leadership can't hold, okay, after it's gone absolutely parabolic, then you have a really unsettled situation. So I think it's been unsettled to the upside. It could get a little nasty to the downside. And we haven't had wholesale selling in the stock market really since, March when we had the regional bank thing. So again, there's been, and you've been saying there's been no real volatility in the stock market until we just had this sort of move. The volatility's been in the bond market. And I got to tell you, Guy, are you a little bit surprised? And we've been highlighting on Market Call for the last week or two, all of the really hawkish Fed speak that we've seen,
Yeah.
right? So the CME FedWatch tool is now pricing about a 40% probability of a 25 basis point hike in June.
Think
And
about that.
I
Yeah.
suspect that's going to be 50-50, as we get into towards the end of the week, especially because we got ISM manufacturing and we have the May jobs data Friday morning. And if that stuff doesn't lay up, like, you know what I mean? Like, we're going to be north of 50%. And so you tell me, if all of these sorts of high valuation tech stocks started to sell off like crazy late 2021, early 2022, because the Fed was about to start raising rates after years of a zero interest rate bound, and now we are Fed funds at 5%, maybe about to go to 5.25. Do these valuations make sense right now because
No.
there's a
Well,
bubble in excitement in one technology?
it's interesting. First of all, Broadcom, and this is an important chart. I think you can't understate this, what we're talking about in terms of another Fed hike. Remember, you had people talk, and again, I don't know where they're getting this from, but you have people talking about rate cuts in the back half of this year, which we're on the precipice of in terms of the back half of the year, number one. So this is interesting. The market clearly doesn't care. Broadcom, which has already traded 7.5 million shares today at 111, typically trades 2.5 million shares. So that's well on its way to trading about 5 or 6 times normal volume. That stock traded to 917 today. It's pulled back significantly. That's a stock that for the longest time you could actually make a case on valuation. But when a stock like that moves over the course of a couple of days, something's broken in the market, I would submit.
Yeah.
And to your point, does it support these? Does this interest rate environment support these valuations? No. I mean, absolutely not. And we're not haters, but you go back historically, every time people said it's different in terms of valuations and why the market can support, go back and look again. Sun Microsystems back in the day and some of the commentary around that company, it didn't come to fruition. It didn't mean the technology wasn't viable and their vertical wasn't viable. It just meant the valuations that they lived in were ridiculous. And I think that's what's happening here. AI is not going away, but the valuations that are trying to support this are folly, in my opinion.
Well, the AI or the valuation is right. It's a function of the demand by investors. So again, and you and I, said this. I mean, the guidance that NVIDIA gave was shocking. I mean, it was absolutely shocking. So there's a lot of folks who are off sides. I've been shorted, and not naked shorted, but I've been shorted, losing money. And to me, if I was like just short the stock, I would have had to cover, you know what I mean? But and I think that's probably what happened today is that people just threw in the towel. That stock was up 6.5% at one point and checked over $1 trillion. I mean, if this stock goes down in the day, watch out, people. I'm just saying, watch the F out. All right. Let's look at yields.
Not that I don't want to hammer NVIDIA. First of all, I agree with you, and I've been equally wrong, but even if this is a company, by the way, that prior to that guidance was on track for like a $32 billion run rate. So even in the best, obviously they guided from $7.5 billion to $11 billion in terms of revenue. So you want to give them a $40 billion run rate ish. I mean, you can do the math off $1 trillion valuation. You want to give them a $50 billion run rate, which I think is extraordinary. It's still expensive at 20 times revenue. So at what point does this thing become? I mean, when do people start to care about valuations? Do you think? I mean, almost by definition, I think, when you start hearing about TAC and all those different things, total addressable market (TAM), and that's when typically these things come to an end, not the beginning, Dan.
Yeah, fair enough. I got it. And I agree with you. Let's look at the yields though. Let's look at the 2-year. It's, very near 4.5%. We see the 10-year at, 3.65 or so. You see a 79 basis point inversion between the 210. That's not getting better. I mean, it narrowed for a bit, right? And maybe that, like, some people thought that was a bit constructive, but some of the data that suggests the longer the inversion and the at the levels in which it has, I mean, something's got to happen sooner or later, your guy. And that 10-year right there, you look at that today, it's down I don't know, what are we down, like 10 basis points or something like that. We were at 385, I think, on Friday morning or something like that. So, that 3.5 level psychologically, maybe that's a bit important. Maybe it's that 3.3 level or something. And you and I have been pretty steadfast. I think the 10-year and the discount to the 2 is obviously respective of future growth, and the 2 is tracking what the Fed is likely to do and where Fed funds is. But to me, this is not particularly great. And if the 10-year were to continue this slide lower, and I think it does, is my guess here, is that some of the growth data look like it's weak. It looks like the China data is going to continue to get weak, and that 2-year is pinned to what the Fed is going to do. I mean, that inversion widens out, and I don't think it makes it better for risk asset valuations. It
We
really speaks to more
I agree.
stagflationary environment.
We brought it up. We brought it up on the tape podcast. The fact that I think at its trough, I think 2/10 went to about 43 basis points or so. I might be off, so don't at me. But very quietly, it's moving back to 75 basis points. Who knows where it's going now? And again, people want to discount it. They say it doesn't matter this time. Well, I'll tell you what doesn't seem to be discounting it, and you brought this up earlier as well, are some of these regional banks, which we don't necessarily have to get into, but the KRE is down 1% today on what was a decent tape. So again, regional banks seem to be telling a continued story. And to your point, the inversion in the yield curve, when it got to 110 basis points, the market didn't like it. Somehow the market thought it was constructive when it went below 50 basis points, but here we are widening out again. It's problematic, in a word. So we'll see. And historically, it does not augur particularly well for risk assets.
Yeah, we got to look at this crude chart here, because it's,
Which
we
is
talk
also
about
a risk asset.
it is, and it seems to be getting riskier. The lack of rally that we've seen, and we talked a little bit about some of the comments that some of the OPEC members have
Yeah.
made. And, there's a meeting coming up, and it just feels really heavy, Guy. It feels like something that you and I, like I don't think it makes us, listen, we like to highlight a couple of trades, and when we're doing, especially the futures, and the use of the the stops makes it really kind of, good to kind of get in there and take some shots. But today's action down 3.5%, 4%, it feels like we're on the precipice of something. It feels like that there's something that, China is about to say about their growth and the like here, because it just doesn't feel good. We've talked about the resource stocks, and coal acts really bad, and copper acts badly, and the stocks act poorly that reflect them, and they're all getting hit today. Where is this growth fear coming from right now?
China, 100%. You hit the nail on the head. And, to a certain extent, obviously what's going on in Europe, United States is probably going to follow, but it's all the bullseye for this is China. And I think we've talked about it now for a couple of weeks. I know we talked about it on Fast Money. More and more, the network seemingly picking up on it. Very quietly, China's shutting things down. It's again, around the edges, nothing all that overt, but one has to wonder what's going to happen if, again, you see lockdowns or shutdowns there. What does it mean to the supply chain? But obviously, in the context of what we're talking about, what does it mean for this underlying security in the form of crude oil? I've been dogmatic without question in commodity. I've looked smart at times. I've looked dumb at times. Today's not a day I'm looking all that smart. 68-ish is your line in the sand. If you could go back to that prior chart, you'll see we bounced off that a number of times, number being 3. We'll see, but you're right, Dan. It does not trade well. The only, I guess, wild card out there, and you brought it up, there's an OPEC meeting coming up, and I'm paraphrasing now, so forgive me, but in a statement OPEC made, it was sort of, if you're short, and again, I'm paraphrasing, be careful, you're going to get the ouchies. Obviously, their use of the language probably escaped them, but I think what they're saying is be careful being short oil in this environment. I think you can get surprised, and it briefly worked in the spring until it gave it all back. We'll see if it works now. I think the market's trying to call their bluff, though, right here at 69 and change.
Yeah, but and the thing is, guys, it's just not cool. It's just not only about oil. I mean, oil's down 4.5% without any meaningful headline, dude. Like that, to me just seems really odd. And I look around, and I'm looking at the stocks, and I'm looking at what's trading today, and I'm looking at industrials trade really poorly. I'm looking at China traded, FXI is down 3%. Like I said, we had a consumer confidence reading, and look at the way retail trades, look at the way banks trade, both large and regionals, and it just feels like, man, it's just like we are holding on to this story that is going to transform the global economy. It's going to transform transform industries, it's going to transform, companies' fortunes and this and that or whatever. And it's just also kind of interesting to me. And I know that we talked about this with Liz Young this morning on the tape pod, which dropped. And it's a very, just, when we do it on a day like today, it's a very different thing than we're doing here. This is meant to be a lot more visual and more trading oriented, a lot more charts. But we're talking about how, Elon Musk's, he landed in China this weekend. Jamie Dimon's going to China this week. Morgan Stanley and JP Morgan are hosting conferences there. Jensen Huang, though, the CEO, of NVIDIA, was over there in Taiwan, where a lot of their chips are made. And also, they were like ground zero for this advanced chip ban from our government. Basically, this was back in September. Do you remember October saying that NVIDIA can't sell certain AI chips? This is before the frenzy, right, to the Chinese. So it's interesting that he's over in Taiwan. So you think about, what are some of the things that could really hamper growth? Well, there's geopolitical stuff now that we have this debt ceiling debate out of the way. So it just feels like, there's not a lot of fear in the market with the 17 VIX. We have some of the growthier things, the 10-year crude, some of the resource stocks, they're screaming about the potential for a slowdown. People are still in the camp that we're going to have a soft landing. And I think that's reflective of just this kind of hawkish Fed that keeps saying that we're going to raise interest rates, because the data still suggests that we need to be vigilant on inflation. But it really feels like stagflation is going to be the thing mid this year, the back half, that will really cause, I guess, some fear back in the markets. That's my 2 cents.
Yeah,
because it's happening about the risk assets.
Couple things. Jamie Dimon, I don't know if it was last week or the week before, so I apologize, but he basically told people to be prepared for 6 or 7% interest rates. I mean, his words, not mine. He obviously has his finger on the pulse. There's no upside in him saying things like that. He's just I think he's sort of stating what he sees on the horizon. And you mentioned NVIDIA. Again, this is not a hate fest on NVIDIA. It's an extraordinarily important company. It's an expensive company as well, but I think it was last Monday that they made comments about the potential devastation in the form of continued deterioration in the relationship between the United States and the Chinese in terms of the tech sector. So they obviously have a lot to lose there as well. So there's probably a bullseye on their back too. And, China Micron didn't seem to get a lot of airplay. Obviously, Micron shrugged it off in terms of the stock. But then you look at some of these other names, if we could pull up an AMD real quick, because I just think it's fascinating. The AMD quarter, which was reported a few weeks ago, or if not, 4 weeks or so ago, market didn't like their quarter. As a matter of fact, I think the stock, which closed around 89 or 90 that day, I think traded down to 81 bucks or so. And here's going to be the chart in a second. And there you can see it. I was actually exactly right. Closed around 90, traded down to 81. Two things happened. They announced some sort of collab with Microsoft, and then they're getting caught up in this whole AI frenzy as well. Again, it doesn't mean that AMD is a bad company, not at all, but it means there's a frenzy going on. And if you don't think that's panic buying, it's funny when it's buying, and we talk about this, Dan, it's always orderly or fundamental driven. But if that was flipped upside down and we looked at that stock going lower, people would say it's panic selling. It's just an interesting juxtaposition.
Yeah, no doubt. Interestingly, let's update a trade that I did, I think about a month ago. I actually was, it was in the US dollar, and we were looking at the Dixie, and we were saying about, the ability to kind of hold that kind of 101 support level, which it did. And we were buyers at 101.5. We were targeting maybe a move back towards that spring high. I guess it was like kind of Marchish. It was just above 105. And you see that 200-day, which is really kind of flattened out. It's declining a little bit. I mean, listen, if you had that trade on and you're up a few percent the way, and a move like the dollar, like that's a big move, and it might make sense to start legging out of that trade, because, to me, I think what happens next is probably correlations across lots of different risk assets going to one, meaning like the volatility. If we were to get some downward volatility in the stock market, if we were to get, maybe just a Fed that just not only doesn't pause, doesn't skip, but raises and then says they're going to remain, vigilant. Maybe that feels like a turn. People very quickly, Guy, are going to start focus on Jackson Hole, the big Jackson Hole summit of the Fed and that sort of thing. We've had huge moves, right, in and around that. So, the dollar will move one way or another, and maybe it makes sense to kind of leg out of that trade because, if it were to come in, it's going right back to that 101, and it probably finds some pretty good resistance to that 105 level, that 200-day moving average also.
Good trade without question. I mean, I still think there's room left to the upside in the dollar, but to your point, it probably makes sense just in a discipline factor to start taking something off. But it's funny. The dollar has moved, non sort of under the radar screen to the upside. Nobody seems to be talking about it. And around the same time, gold took a leg lower. But gold, if we have a chart real quick, because the dollar takes us right to the gold chart, we held this sort of uptrend that we're in the gold market. And I think if gold can rally, and your eyes can see that, I mean, we didn't draw the trend line, but if you look at the November low, then you look at the March-ish low, and then this recent low, that's a pretty significant uptrend line that we have held, in my opinion. And you're seeing sort of the move today. So if gold can continue going higher in the face of a dollar that seems to find its footing, I think that gold trade that we highlighted last week is still alive as well, Dan.
Yeah, we threw in the Bitcoin chart in here, Guy. We haven't talked about Bitcoin a little bit. And so this is kind of one that I thought was interesting because it was really around the time of the regional bank crisis, right? And you see originally it sold off. Like correlations were pretty high among risk assets, right? In early March. And you see that sort of sell off. And it's funny though, if you go back 2 months, okay, when Fed fund futures really were pricing in legit cuts by the end of the year, what did you see to happen in Bitcoin? You saw it rally. It came off the mat there, right? And then it sold off and then went it up in a straight line when everyone's like, oh yeah, this is why we own Bitcoin, right? Because the traditional financial system is going to fail and we're just going to continue to debase our currency. And that's the only way that we basically have to combat these sorts of issues that we have in the banking sector and that sort of thing. But it's interesting today that it gapped up. Is it that we're closer to the Fed basically being done? I know this sounds so stupid, you know what I mean? It's kind of funny. I don't know why, but it's something worth keeping an eye on.
Yeah, well, I don't think it's coincidental that gold's bouncing today as well, and I don't think it's coincidental that the regional banks are taking another. Obviously, they've bounced off the lows, but they're taking a leg lower here today. So I think they're all part and parcel. I mean, I think there are things below the surface that the market is trying to sniff out, but nobody seems to want to acknowledge when you have an S&P seemingly goes higher every day, and when you're basically have this frenzy in these AI names, and it is. Listen, you call it what you want. You could say it's fundamental. I mean, I think Doug Cass wrote about this earlier today. This looks eerily similar and sounds similar to what we saw, 23 or so years ago when people were talking about these and valuations didn't matter. The internet is clearly still here, but there have been some winners and losers along the way. And oh, by the way, along the way, the market realized those valuations were unsustainable. And I think that's what we're sort of going to try to figure out from this point. Doesn't mean that AI is going away. I can't speak intelligently about, again, the total addressable market of AI and who's the winners and losers going forward. But what I will tell you is this reeks of what we saw 2 decades or so ago, Dan.
No doubt about it. And the biggest winners back then, while they didn't have the kind of like earnings that these companies have right now, a lot of them lost 50 to 70, some lost 80% of their
Yeah.
value. It took them like 2 decades to get back above it. Microsoft was a great example of that, a company that actually had real earnings and real sales. And, it took them, I think, 15 years to get back above its .com high. One last thing here, and I know Doug's been hitting this, and we've been hitting it too, Guy. The Russell 2000, we have the futures. We made this chart up before. We didn't hit that. When I look around, I was mentioning all those other sectors that are not acting well, but look at the market cap. And again, we know that they have exposure to regional banks and energy and that and the like here. But with rates going higher, or just a kind of more hawkish tone, look at how this sector act. I mean, like the small caps act. They just don't act well. So to me, again, I know I'm fighting it here, people, but I just think that watch out. Okay, Nvidia was up 6.5%. Now it's only up 3%. We already talked about what Broadcom is doing and how much it's off its highs. if mega cap tech, if they lose this one, you're going to see an acceleration on a day where you already see, commodities trading horribly. You're seeing small caps trading horribly. You're seeing banks really trade poorly. And that is the trifecta to me right there.
Keep this visual, and I don't know if Jacob can do this. I apologize if it's difficult to do, but just have this visual and look at the equal weight S&P, because I'm going to tell you something. It's going to look eerily similar.
Yep.
And I think those two charts, so that's the Russell 2000, and if we can quickly go back to the equal weight S&P, and I'm sorry, I mean that's pretty similar looking chart, right? So just keep that in mind, because I think those two. Listen, the headline story is what's going on with these mega cap stocks, AI, and everything, and people are all getting jazzed up. The below the surface story and the second, third iteration story is what's going on really below the surface with obviously the small cap stocks, and to a certain extent, what the market looks like if we equally weighted this entire thing. So just keep that in mind, Nathan.
I got you. I will keep it in mind, Guy Adami. That was fun. We had a hot 30, as they say. Do they say that? I don't know.
I
Does
don't know.
someone
Do
say
people
that?
say that?
I
I'm
don't
a
know.
little hoarse. I apologize.
Yeah,
I don't
you
know if
okay?
I'm always,
I
indestructible, as they say.
I saw you at the Yankee game up in the Bronx, and one of us was crushing a 24-ounce ice cold Bud Light. The other
Wasn't,
one,
yeah.
no, was not. That's not
I
your
was
jam.
probably having like a hot chocolate or something.
Were you really?
Yeah,
Yeah.
well, probably. I'm not. You see some of the people in these crowds that they seemingly have one of these beers every inning. It's like, really?
Yeah,
mean,
I was one of them for the first 4.
yeah, no, I can't roll like that, because I'd have to go to the bathroom.
Yeah.
I wouldn't get out of the bathroom. But that's what happens when you're my
Well, you know
age,
what? You
Dan.
always say you have a memory like an elephant. I have a bladder like a camel when it comes to a nice hot
That's
day or a concert or something like that. So,
that's
just saying.
impressive. Run with that.
All right, let's do it here, buddy. This was
All
fun.
right.
We laughed, we cried. I cried, you laughed.
We don't listen. We come every day to play. I mean, that's
Yeah.
we're not hiding from anything. But that's it for today's market call. I want to thank our sponsor, CME Group, where risk meets opportunity. Obviously, our data provider is FactSet, as Dan said, financial data and analytics powered by Tomorrow. Tomorrow, of course, will be Wednesday. Wednesday is a Carter Braxton Worth day of Worth charting. We'll see what he brings. I guarantee it's going to be something next level, Dan Nathan. So with that, I bid you a fond farewell.
Yep. See you. Thanks, everyone.